Individuals with a taxable estate must act by the end of 2016 to avert the possibility of a nasty hike in what will be owed to the IRS at their death. Not to be maudlin or insensitive, but no one gets out of here alive. If you don't plan for the possibility of a proposed change to regulations enforcing Section 2704 of the IRS Code, your heirs could be forced to pay a very high price. The IRS has long allowed individuals to lower the tax levied on their estate using liquidity discounts. Say you have 3 children and own a business worth $15 million. You could transfer equal interest to each child over a specified period of time. Divvying up the tax among 3 children would mean no one person controls the company. That adds new uncertainty about the future of the company, and therefore, each child's interest in the company is less valuable. Each child could discount the value of their interest in the company by as much as 30% for estate tax purposes. In the case of Tom, Dick, and Harriet, they could reduce the value of their interests by as much as 30% and would owe estate tax on an interest valued at $3.5 million instead of $5 million. For years, the IRS permitted taxpayers to take haircuts on the value of partnerships holding interests in manufacturing, service, real estate, and other businesses. But that led to some abuse, like taxpayers placing marketable securities in a partnership to lower the value of stocks and bonds for estate tax purposes. It was widely expected that the IRS would recommend ending the abuses of valuation discounts, like placing marketable securities in a partnership, and calling that an active business to claim a valuation discount and owe less tax on an estate. No one expected the haircuts on valuations of active businesses would be affected by the IRS's newly proposed rules. And that's where the surprise came. The IRS proposed limiting valuations on active businesses, as well as borderline schemes taking advantage of the rules. If you own assets worth millions or have been gradually transferring your interest in a business as part of an estate plan, the new regulations are widely expected to be adopted. In fact, it could happen as early as the end of the year. After that, it could be too late to minimize the tax your heirs owe at your death under the changes to the rules implementing IRS Code 2704. This is not the kind of surprise you want to leave your heirs open to. So please give us a call if you have any questions or consult with a tax advisor.